Thank you. Thank you. Like you mentioned, I did go to the University of Florida. I graduated back in 1988. Back when to get into the University of Florida, you just had to breathe on a mirror and it fogged up a little bit. You got in. A little different story these days, and it's a real credit to you guys. But it's really great to be back. I was really excited when I got asked to do this. I've always had a great deal of respect for this university. I've enjoyed my affiliation with it. And, you hear this all the time, but as you go through your life, it truly is a Gator nation, and certainly in the business world. And you'll be surprised, I was telling the group that I had lunch with today how, when I was just 15, 20 years ago when I was a commercial lender, and I'd pick up the phone and call the CEO of another company, if he was a Florida graduate and he knew I was a Florida graduate, you'd get in the door. You might not sell him a product, you might not be able to get his treasury management business or his lending business, but you certainly would open the door. So it's amazing what this university has done, and this facility is absolutely amazing. I was wandering around lost earlier. But let me start the presentation. Please interrupt me at any time with questions. I mean, this is not a real long presentation, so the point is to have a lot of interaction. And one of the things I discovered as I was out there is a lot of you are going into investment banking. So I'm going to kind of tweak this a little bit and talk more about investment banking, acquisitions, acquisition accounting, and that sort of thing, which you'll be doing at 3 in the morning in New York or wherever you are when you're doing your analysis for people. So just quick facts about the bank, just so you understand kind of my background and the bank's background and our experience level. We're not Citibank, obviously. About a $975 million bank. We're headquartered in Fort Lauderdale, Florida. We started in 2005. We raised $40 million initially. Our initial offering was the second largest offering at that time ever in the state of Florida when we came out of the box. We have currently 10 offices in Dade, Broward, Palm Beach, Lee, Hillsborough, and Collier counties. We're not really a retail bank. Private bank for business, I mean, we do not open a lot of retail branches, basically. We cater to, on wealth management side, we cater to small corporate customers, developers, and that sort of thing. So we're not really, you would never see us advertise, for instance. We've had 28 straight quarters of profitability. We're the only bank in Florida that through the entire cycle never lost money. I think you've seen the carnage that's happened in the banking industry. And today we're sitting with $126 million in capital. We're traded over the counter, SGBK, so those of you that are doing your little stock asset allocations out there, you can actually pull us up and see that we're traded. We have about a market cap of about $150 million today. This is what we really want to talk about, though. Since 2009, we've acquired 4 banks via the FDIC resolution process and 1 open bank transaction. And 1 open bank transaction refers to basically just a regular merger, and that was a bank in Fort Myers. But we have acquired 4 banks via the FDIC through when they fail a bank. And I think there's maybe 3 or 4 of us out there in the state of Florida that have actually done that many. So we've done our fair share. Why should we care about resolution of bank failures? Well, there's obviously, it impacts the customer. Whenever a bank fails, CD rates can change, service charges can change, corporate customers could have their lines of credits taken away, and so on. I mean, so it does impact the customer, it impacts the economy. So a bank failure, while we've made a lot of money on them, is not necessarily a very good thing for the local community where it happens. Employment. As you get into investment banking, you're going to see the famous word cost saves. I mean, any acquisition you do, cost saves are critical. When we're evaluating an acquisition, you don't need 2 CEOs, you don't need 2 of me, you don't need 2 CFOs, you don't need 2 COOs, and so on down the line. So obviously, that obviously impacts employment, and typically you're going to see in a failed bank deal, you're going to see between 40 to 60% of the employees, unfortunately, lose their jobs. So it obviously impacts employment in the local area. Repudiation of contracts, and this is something you don't realize with failed bank deals, is the government has the right to repudiate any contract that is out there on a failed bank. So the first failed bank deal we did was interesting. The CEO had a Lexus, and it was a lease. And the CEO obviously left. And the Lexus was sitting out there, and the FDIC person came to me and says, well, do you want the car? And I said, no, not really. I don't really like Lexus. And he said, okay. And he called up the local Lexus dealer. He says, pick up the car. You know, what do you mean? We have a lease with the banks. The bank doesn't exist anymore. Pick up the car. The lease is expired or lease is done. So the government holds a lot of power. And you might say, well, that's a little thing. But you know, when you've got branch sites, for instance, if you've got a lease on a branch site, they can repudiate that lease. You can leave that particular geographic location and go from there. There was basically 2 banks we bought in Naples back to back where it had 7 branches combined, and we took that down to 1 branch. So 6 branches basically were repudiated leases. The ethical question, of course, of whether another bank should benefit from the demise of a failed institution. I mean, and that's something that as we go along here, hopefully, you know, you guys will chime in. I think there's positives and negatives. I mean, this is a very unique situation where, you know, government and private enterprise are working to resolve an issue. I mean, you don't see this in other issues. Other instances, maybe GM, but for the most part, you know, this is a common thing that was going on. This is the biggest probably thing that's going on in terms of banking and in general with the failed bank situation. There's approximately 7,000 banks in the U.S. 1 bank a day goes away. So 5%, roughly 5% of the banks in the country will disappear over this next year due to merger or failure. Some people say there's too many banks. But let me give you a couple of statistics here. In 1970, the 3 largest banks had a 25% market share in the U.S. Okay? Today, they've got a 50% market share in terms of assets in the U.S. Okay? Community banks, which is defined as anything under 10 billion or less, have 10% of the assets. Any guess as to small business lending, as to, you know, don't believe the commercials you see out there. Any ideas to the level of small business lending, the large 3 money center banks, what their market share is? 10%. The community banks, 40%. So when you look at the economy of the U.S., you know, that's a serious headwind that we've got to get over in terms of these smaller banks are the ones that generally lend the $2 million loan to the entrepreneur that's, you know, got 40 employees. So when you look at employment, when you look at these companies growing into bigger companies, you know, the banks disappearing is going to have a major impact. In the FDIC, these are FDIC statistics, by the way. It's supposed to accelerate. Actually, the American Banker Association said that they thought there would be 1.5 banks would disappear. Now, what's happened is, and we're going to get into fair market value accounting in a little bit, what's happened is there's an expectation that the failed banks are going to slow down, and they are slowing down. But what's going to happen is the merger activity due to regulatory compliance is going to increase and force more banks that are maybe just kind of stagnant into merging with other banks. So they actually thought it was going to increase. That's a good question. Let's talk about Florida. When I started the bank in 2005, there were 350 banks. Today, there's 250 banks, roughly. 62 banks have failed in the state of Florida. We talked about this in the lunch I had with a few of you. Florida is highly fragmented. You know, this is one of the largest populous states in the country. Yet, we've got 250 banks. 52% of those are under 250 million in size. You know, we're basically almost $1 billion, and we're like 28th in the state. You know, if you take away the Spanish subsidiary banks and stuff like that, we'd probably be like 17th or 18th. So really, from a banking perspective, Florida has really been impacted a great deal by all these bank failures, because some of these were fairly large banks, like Bank United and so on, that failed. So down the road, that could have an impact, because, you know, a lot of the credit decisions, a lot of the rollout of services, whether it's wealth management or anything, are not done in Florida. They're done in North Carolina or New York or wherever. So there could be a big impact to the state of Florida in terms of the economy. How does bank fail? This may seem basic, but let's talk a little about it. Lack of capital is the 95%, 98% of the banks fail for a lack of capital. Basically, you can leverage $1 million of capital into anywhere from $10 to $12 million in assets. So what happens is when let's say you've got a bank with 10% capital, and they've got $100 million in assets. So they've got $10 million in capital. And then you take $2, $3, $4 million of losses. Let's say $4 million. All of a sudden, you're at 6% capital. You start getting regulatory guidances and compliance issues. They start popping in. When you drop below that 2% level, and then typically the government will go in, not all the time, but typically will go in there at that point and say you're critically undercapitalized, and they will take you over. So 95% of the time, you'll see that is the most likely scenario why a bank fails. Up until recently, it was very difficult for banks to raise capital if you had any problems. We're starting to see some capital enter into the banking system, but it's hard with a lot of the regulatory compliance issues and what's going on in terms of to get the right return on assets, right return on equity to really make sense of where we are. But now people are beginning to feel a little more comfortable in terms of being able to mark a loan portfolio, mark a securities portfolio, and be able to tell what really is the true value of that bank and be able to peg accordingly. So we're starting to see a little bit of capital.
A couple of questions. So the lack of capital, the asset value, capital liabilities, is that mostly for the credit, loans gone bad, or some other? That's basically the only bet they have, right, on the balance sheet, the interest rate duration is bad.
No, I think most of it was credit related. Now there was some stuff in securities portfolios. I mean, you saw a lot of banks. Believe it or not, banks would. I don't know if you guys have heard the term trust preferred. If we had a holding company at the bank level, we could go borrow from other banks on what we call basically a trust preferred, is basically equity. And so when a bank would fail, if they had trust preferred, at that point that would go away. It's like a preferred stock almost. And so that would go away. And so you had some instances where that was a problem. You had a lot of banks were invested in Fannie and Freddie preferred, and they took big hits on that. So mostly credit, though. You're right.
And then if I thought of these large number of banks, 250 now, 350 prior in Florida, they run on it. Their capital is low. They're not publicly traded. How do they get into fusion? They're just the family founding order after pulling up.
Yeah, well, it's two ways. Well, three ways, basically. Friends and family, is what they call it, what the boards call it. That's what the board, everyone passes a hat around and they put 2 cents in, and hopefully it adds up to a number that's meaningful. That's one way. You can go to the investment banks. You can see if they can raise money. They have not been very successful with distress situations in raising money. But you're also starting to see more foreign, now they're not very many of them don't seem to be getting approved, but you're also seeing a lot of foreigners coming in, especially Central and South America now, that want to acquire a controlling stake in some of these smaller banks and use that kind of as a platform to grow into something bigger. But that involves a lot of approval process, which sometimes may or may not happen sometimes. So those are basically the three ways. But that money has been very scarce up until recently. It's been very difficult to attract that. If you're in a bad situation in terms of capital, it's been very difficult to recapitalize.
So if you lose that capital, you get down to that threshold where you were near that threshold where the FDIC is involved, that's usually the game.
yes. Yeah.
Yeah.
I mean, literally. I mean, we took over one bank in Tampa, and the chairman of the board was holding a check for $20 million, or no, wire instructions for $20 million. He said, "This is going to be wired in," and it's like 5 o'clock on a Friday. Now, whether it was or not, I really don't know. But at that point, it was too late. It was that. So there is a point where you just point of no return. Next thing is lack of liquidity, and this is probably very unlikely, but I'll give you the best example of that is Wachovia. Wachovia was taken over by Wells Fargo. They were losing $500 million to $1 billion a day in deposits in 2009 during the run, and it really came down to, they had plenty of capital. It came down to a liquidity issue, meaning the deposits were running out so fast that they couldn't fund their different obligations and so on. That was something you saw in the Great Depression. That hasn't been as big of an issue this go around as it was in the past. And then there's unsafe practices. Unsafe practices would be if you're allowing money laundering going on at your bank, and you consistently do it, and you don't change those things, and compliance issues, or unfair lending practices and that sort of thing. That's very unlikely that would happen. I mean, the board would probably just replace the management team, there'd be fines, and that would go on there. But it can happen. So, well, that's kind of the overview. Let's get to the more interesting thing, and that's how do you acquire a bank from the FDIC? It's actually quite exciting. You know, the last 3 years we've really I think it came out in a lunch again how you know, you get into this thing and it's a very quick process. You have to be able to make decisions on the fly. You have to be able to model things and this is where your job, this is where your education comes into play. You have to be able to model these things with not all the information. You got to make assumptions. What happens, I'll just go through the actual process. The FDIC has a certain group of banks that are approved to bid on other banks. And typically they don't allow you to buy anything that's more than half your size. So they don't want you taking on any risk that could impact your balance sheet. So what we do is literally I'll get an email. I'll be on my smartphone, and I'll be walking along, and all of a sudden I get an email, and it's from the FDIC saying, look, we have an opportunity in Timbuktu, Florida, and it's a $300 million opportunity. If you're interested, please contact us. And at that point, if you do have an interest, if we wanted to buy a $300 million bank, you would notify the FDIC, and they would have a very high-level website prepared that you could do high-level due diligence. And I mean, this is very basic. You'll have like a list of all the loans, the interest rates, securities, the facilities and that sort of thing. Very, very high level. You can't really gather a lot from it. The credit quality, what they've reported on their call reports and that so on. So you'll have that available. Assuming you like what you see and you like the location, the geographic location from there, then you would contact the FDIC further and ask to do on-site due diligence. And this is the amazing thing. You're limited to 2.5 days, 5 people. Maybe sometimes if they got a big conference room, they'll allow you to sneak in a 6th person. But you've got 5 people to go in and evaluate a bank. It could be $500 million, it could be $100 million. Go in there and evaluate those assets and build your model. So the key component of that is obviously you got to have the right 5 people coming in with you in terms of being able to do it. Because every bank, not just is it a loan portfolio may have weaknesses. You may have instances where they've got money services businesses, or it might be money laundering going on, or they may have serious issues in their securities portfolio, HR issues. All of that stuff you've got to evaluate in 2.5 days. So you get to do that for 2.5 days. A closed bid date is set up. Usually that goes on for about 4 weeks, that on-site due diligence. So there may be 8 banks that are allowed to really get on-site. After the last bank goes in, usually within a week after that, they're closed. Well, right then and there, they set a closed bid date for like the following week. So at that point, everybody bids, and I laugh because initially when we were doing it, you'd fax in your bid sheet. In this day and age, I always thought that was kind of funny. You'd be faxing your bid sheet to the FDIC in Washington, and here we're talking about millions of dollars at stake, and if you'd be faxing it, it'd say busy, and I'd be like, whatever happened to scanning, But anyways, so now they do allow scanning. But so you send your bid in, and then those bids are evaluated, and the bid that's selected is the one that's the least cost to the fund. And by the way, you can send in multiple bids. You can say, look, I'm going to pay you X. If you allow me to close this branch, I'll pay you Y. And the way the bids typically work, it's a discount to the assets. You just give them a number that you do. And so, the whole process is you've got to build this model. And that's what I'm going to probably go into, deviate a little bit from this and talk about this because it seems like this would be of interest to you guys. So in that 2.5 week period, you've got to build a model both of the loan portfolio. And you got to remember, it's not just one type of loans. You could have residential loans, you could have commercial loans, you could have consumer loans, corporate loans. You've got to build a loss model over what kind of losses you're going to achieve on that. Then on top of that, you've also got to build a model of interest rates. Why would if you were to take a bank that has 15-year fixed rates all over, what if interest rates go up? All of a sudden, you've got a real problem. The securities portfolio, you've got to build a model. So you have to build this model, and every bank's a little bit different, and you have to make a lot of assumptions. You've got to make assumptions on loss rates, by the people that go in there and evaluate those portfolios in that 2.5 days, what's the quality of underwriting, loan documentation.
It just seems really dangerous to limit somebody's evaluation to 2.5 days. Why would they do that?
You know, that's a good question. That's a very good question. Maybe it's timing. You know, when this whole, the government was really understaffed. They did a wonderful job. I mean, people don't really give them a lot of credit, but they did a wonderful job of really reacting to this crisis and how many banks failed. I just don't think they had the staffing in place to really, my guess, I'm guessing, I'm talking for them, I shouldn't be doing that. My guess is they really didn't have the staffing to extend that period for any length of time, so.
This is a fascinating question because my daughter likes this show, so I watch it. Storage Wars? Yeah, this is like a huge high-stakes storage war. And, you know, I always told a teacher a little bit of economics that if you really want to maximize the value of the apartment, you know, you just lay it all out there, right?
Right.
But they don't do that, and that because it makes for good TV. But this, I think they do it for the speed, right? Because
Right.
you can't have this crippled bank moving along for several months, right?
Well, word will get out. You know, you do sign a confidentiality agreement. And one of the questions that came out of lunch is, well, how many people know about this? Well, you know, you don't want to read this confidentiality agreement. It's like they'll take your firstborn, you know, if you divulge. This is the government we're talking about here. So, you know, we would limit the amount of people that would know in the bank. So maybe 8 to 10 people would know up until about a week and a half beforehand. Then obviously you've got to deploy more staff to go in when they go in. So it is a very hurried process. You know, and you've got to make a lot of assumptions, and you got to move very quickly. And we're going to talk some of the issues and fair market value and that sort of thing in a second. You know, the other thing that's really amazing what the government does, they'll show up with 60 people. And they'll show up 60 people on Friday, and that Monday they'll leave maybe 5 people behind. And that bank was this bank on this date. It was the FDIC for about 5 minutes, and by that Monday, it's Stonegate. It's done. I mean, everything. I mean, it's amazing how efficient they are. They'll have the computer people in there. Not only that, I mean, they're downloading hard drives. I mean, it is absolutely amazing how they go in there. They really had it down to a science. But you got to be, once again, money can be lost. You got to have your staff prepared. You know, and also too, it's a very traumatic experience for the people that are being acquired. I mean, you know, it's you know, here you got police coming in and federal agents and that sort of thing, and it's very traumatic for them. So you know, you have to make those people feel very comfortable that, look, these things happen. Doesn't mean you're a bad person, so on and so on. So.
Just so I've seen this before, so I probably are a little bit more ahead. But you bid a percent of the liability or something else?
Percent of the assets. The discount.
Or the sort of face value of the loan.
Yes.
You bid less than 100%.
Yes. There's 2 ways to bid, and there's one where you just get your money up front from the government, and that's just a strict, and that's the way we did it. And there's another way called loss share, and I'll explain the difference. What we would do is when we model the thing out, you'd model out what you think your losses are going to be. You model out your conversion costs. You model out your stay pay because you've got to run 2 banks concurrently. I mean, the computer systems don't talk. I mean, you're not converting them probably for 6 months down the road. So you've got to run 2 banks. So you model out all that and you figure out, let's say it's a $100 million bank. We think it's going to cost us $12 million. Okay. Then the game comes in terms of bidding is, do we want to make a profit at this? You don't know what anybody else is bidding. It's a closed bid. So that's where it gets interesting, and that's where you say, okay, well, you know, I think we're going to lose $12 million, but you know, for the headache of this, I want to make $7 million. So I'm going to bid 19. Or, you know, I'd bid like 18,999,000 or something like that. It's just like a game almost, because it is truly whatever the lowest cost is. So knowing what your competition is, who else has gone in, you're not supposed to know. Usually you figure it out. And knowing how much they want that franchise, and then obviously doing your analytical work. Now, the other method is the government, for a lot of transactions, especially early in the game when they had a hard time finding people to bid, was they would enter into a loss share. And a loss share simply is, I would take that bank, still apply a discount, but instead of that 19 million, let's say, it may be 5 million, and the government would take an 80%, basically a 80-20 loss share. So any losses going forward, I would eat 20%, they would eat 80%, and it's a 5-year deal. It's a 5-year deal. We opted not to do that because we felt like we could move those assets quicker because there's involved, you have to have a department, the accounting, you can imagine with the government. You know, and they also have to approve any sale of any assets that you have. I mean, so we felt like we could move quicker, clean up the banks quicker. I think it's borne out that that was the way to go. But a lot of banks did the loss share. You should see the accounting on that. That is real real interesting. And another thing that's going on right now is that the time, we all underestimated the time to clean up these problem assets. I mean, the legal system's slow. You know, sometimes you get borrowers that really fight you. Sometimes, you know, you try to have a new disposition to an asset and it didn't quite work out, but you didn't find out for 36 months later. Those loss shares expire in 5 years, and there's a lot of banks right now that are really scrambling because they thought they'd have everything cleaned up in 3. Now they're 5 years into it and they still have 40% of the problems. And the government's saying, look, if you don't have it cleaned up at year 5, you know, we're going to true up, but it's going to be our number that we're going to true up on. And so that's a little scary proposition when that happens. Any questions concerning process?
I want to know, what was your opinion of private equity coming in and participating in the bid process?
It was good initially. You know, one of the things, we were one of the first banks to bid in 2009, and we made a lot of money on, not the first bank, we kind of were feeling our way around. We didn't know what we could do, and to be honest with you, we probably didn't bid as aggressively as we needed to, but on the 2 banks in Naples, we made a lot of money. I asked the FDIC, I said, you know, God, we made a lot of money, and you know, Bank United, which if you guys aren't familiar, was about a $13 billion bank. A private equity firm came in there, got them at a huge discount. In my opinion, that was by design. They needed the private equity to get in there. They needed a few of them to make a lot of money to get other people in. So in the long run, when you average it out, I believe the FDIC did better because you know, the bids were much more aggressive in their favor as time went by because they saw the huge profits that were made. So the FDIC and the government, by allowing private equity to come in, I think would really benefit in cleaning up the system faster. There just wasn't enough capital out there either. It really needed them. I mean, in 2009, things were pretty dire. We really needed that extra capital. Anything else? Why would you want to buy a failed institution? Potential increase in market share or good branch locations. I think in some cases, some banks look at that and see, you know, look, I've always wanted a branch in the north part of town, and I've always wanted to enter this market, and so on. And I think that's a very good reason as to why a lot of banks have done that. You know, once again, you get to go in, you get to, let's say the lease, they're paying $35 a foot for a prime location. The market's $20 a foot. You can go in there and say, look, you either lower the rent to $20 or else the government will repudiate this lease. And believe me, that went on all over the place. So you were able to actually, you know, get your costs down, enter locations that you wouldn't normally be able to enter. So that obviously was a big driver to doing business. Can keep potential rivals from gaining market share. We saw some of that, certainly in smaller towns where people didn't want necessarily another bank coming in to compete with. That's probably less of an opportunity. Bargain purchase gains are increased earnings from the accretion of discounted assets. I mean, this is the main reason why we did it. I mean, there was a lot of opportunity to make money. And by the way, when you talk about, you know, it seems kind of dirty that we're making money on the government, you're really not making money on the government. The FDIC fund is funded by the banks themselves. We pay assessments every quarter. So it really was, when these banks were making these bargain purchase gains, including us, we were just taking money that all the banks contributed to in the fund itself. I mean, and you see in the paper these days, you know, you still see like the government lost $30 million. The government didn't lose $30 million on a failed bank deal. It just came out of the fund, and probably what will happen is in a year, the assessments will just go up for the banks to cover the cost. So it's a little bit of a misnomer that's out there. But the bargain purchase gains are increased earnings from the accretion of discounted assets was the main reason why we did this. And that's going to, let's talk a little bit about that. I mean, a loan, or any asset for that matter, has to be fair market valued coming in. So think about 2009, what was going on, or even 2010. If you've got a loan, normally let's say you're making a 5-year loan at 4.5%, but you've got a loan that's on the books of this acquired institution at 6%. Would that loan trade at par or above par on a fair market value? Is it worth more to the acquirer than what he could go out and get in the marketplace today? It's worth more. It's worth 1.5% more. So there would be an interest rate mark on that would be higher. So all of a sudden, you would be getting a higher price for that. You could accrete that difference over a time frame. Also, let's say you have to make assumptions in a loan portfolio, you categories. Let's say we take a bunch of single-family resident homes loans, okay? We pool them, we put them in pools. And we say, look, we think the loss rate is 23% on this thing, okay? What happens is that loss rate is accreted back over a period of time. So over the amortization of that loan, it goes on there. So what happens, like in one of our portfolios, like in Naples today, we're earning about 10.5% on that portfolio when you take the accretion of those assets back. You know, when today when we're out originating loans, we're probably getting 4.5%. So it's a highly profitable thing. That's where the investment banking comes in. Is, you know, how do you come up with what the true value of something is today? And it changes. Today, if you took, in 2009, if you took a loan and it was paying at 4.5% and there was no credit problems with the loan, if you tried to sell that loan, you probably would have gotten 96 or 97 cents on the dollar. Today, if you had a loan, no interest rate risk, no credit risk, perceived credit risk, you'd probably pay 101 or 102 for that. So at that given time, there's value to those assets depending upon when you hit the cycle. And as you get out there, and if you're an analyst with Robinson Humphrey or Sandler O'Neill and stuff like that, you'll have to make those assumptions when you're looking at portfolios. Due diligence consideration, obviously credit quality. You don't want to buy a bunch of loans and you don't mark them correctly and they go bad. I mean, that could really be an interesting situation. And you've got to make a lot of assumptions on that. You know, it was very tricky in 2009 and 2010 because you didn't really know where the bottom was. Seemingly every time you get on the internet every morning, something else had happened that was bad. So you had to really be concerned about what, you know, where was the bottom? I mean, if you said, look, this house is worth $100,000 today, what's it going to be worth 2 years from now? So you had to make an assumption, say, okay, we think prices are going to go down another 20%. So when you're doing your due diligence, when you're making your model, you had to go ahead and you had to spread that out across the board. Sometimes you guess right, sometimes you guess wrong.
You described the money which required banks, and you lend to small businesses.
Mm-hmm.
So they probably operate in South Florida. When you go across the state and you're requiring a bank in Naples, you know, if they're lending to that bank you're requiring in Naples, so localized that you have to really reacquaint yourself with real estate prices, businesses, the whole loan book is different.
Yes, absolutely.
You haven't talked to any of those customers in your own business.
Right. Right. Very difficult. I mean, you got to look at the loan documentation. You look at, some of it's subjective. I mean, you look at the underwriting they did initially. Was it shoddy? Was it good? You know, was it just a factor of prices going down, the economy, or was it just bad from the get-go? But you know, you build a model. What we would do is we would build with maybe 10 different loan categories. And during that 2.5-day period, by the way, of those 6 people, usually 4 were on credit. We would look at so many equity lines, so many single-family homes, and maybe we looked at a real fast pace, maybe 20% of each category. And then from there, we would figure out, okay, what's the losses on that 20% today? And then we would take the rest of the portfolio and say, okay, well, then we're assuming if it's a 20% loss, we're assuming it's a 20% loss. On the 20% that we looked at, 20% loss, we're assuming it's a 20% loss on the 100% of it. And then from there, you would build out accordingly. Well, now, what if that's today? What if the economy continues to get worse? Then you would have to build out from there. And that's when it gets kind of a guessing game. I'd say out of the 4 we did, 2 we did an excellent job, and 2 we did an okay job. There's 2 that probably where we didn't quite hit it right. So it's a lot of sleepless nights trying to think about, you know, what variables can happen and that sort of thing. Any more questions about credit quality? You know, another thing too, you got to look at how fast can you work through the problem loans. You know, I mean, great, they're a problem, you've written them down. You know, a problem asset remains a problem asset. I mean, we spend our bank particularly spent $80,000 a month supporting, you know, taxes, insurance, cutting the lawn, litigation, you name it. So that's another thing that you have to factor in when you're looking at a failed bank deal or even an open bank deal, a regular bank deal. how fast can you get through that? And the court systems in Florida were very tied up, and it usually took a little bit longer than you really felt, but you had to build that in as well. Talked about evaluating potential losses, bidding correctly. Securities is another issue. Back in 2009 and 2010, you have to remember that there were some securities, like trust preferred, some preferred stocks that were very difficult, munis that were very difficult to move. There wasn't a lot of liquidity in those stocks. So you had to, or the securities, so you had to really be able to evaluate that as well. So you have a liquidity mark on them you had to look at. Once again, it's impossible to look at everything. The financial model of future loan losses is probably the most critical portion of it. But what I really want to focus most importantly is, yeah.
So on the credit quality, working through the problem, I guess sometimes you just forgive some principal and the schedule that if you think the company's really viable, they just borrow too much to
Right.
do that. That seems easier. But if they, what kind of loans that you would make it to banks if you truly foreclose? What are you generally getting? Some piece of real estate that has a failed business on it? Is that what the banks are getting at?
Well, I mean, it's like anything. You got to look at what your recovery going to be. In a lot of cases, with corporate customers or business customers, it made more sense to do some type of an accommodation, such as a write-down and then a re-amortization. But that's, once again, evaluating them on an individual basis. Sometimes if they had a bad business plan to start with, it doesn't matter what, if you give them a write-down or not, bad business plan is a bad business plan. Or if they're just not very honest. I mean, those some cases as well. So it just really varied across the board. I mean, there's homeowners, we forgave debt principal on some homeowners where, there are clearly some instances where they just weren't going to make it on their own, but they were good people, bad circumstances. And so it just varied across the board as to what you would do. Sometimes your first loss is your best loss. It's just better to take back the property. And not always times was it real estate. You're talking receivables and inventory and equipment and things like that.
So are there vendors who handle the disposition of all that kind of stuff, or you have a staff?
They are, and getting back to private equity, that's where they got in big. Private equity was, we'd take a failed bank, and I'd get 15, I'm not exaggerating, 15 phone calls and maybe 30 emails within that 24-hour period of different firms that were buying these assets at discounts, and maybe paying 30, 40 cents on the dollar,
You just acquire a bank, you're letting the next lending corporation.
yeah.
We know they have some stuff that
Yeah.
you don't want to mess with, buy it.
Yeah. But, there are also companies out there that will actually handle your real estate owned and your foreclosure activity and stuff like that. But at the end of the day, it's like anything. It's like, I don't know about you, but I'm always more careful with my money than I am with somebody else's money. I shouldn't say that, I'm a banker, but, but the reality of it is that that's the truth. And so you're going to recover a lot more if you can do it internally. So, but there was a lot of money made in distressed assets and being sold in this time frame, that's for sure. But let's talk about fair market value. This is something that is, if you're going into investment banking, is going to be something that if you can get a handle on it and understand it, and it really is a make or break it thing with any acquisition, whether it's a bank or not. I'm going to talk about banks. Banks are not, our balance sheets are not fair market valued, which is probably a good thing, because if everyone had been fair market valued in 2009, we all would have failed. Because of the very thing I was telling you, a par loan was trading at maybe 96 cents on the dollar, so imagine what that would have done to everyone's equity. But any bank that we acquire, any asset we acquire, comes in at fair market value. And fair market value simply is what somebody will pay for something. You take this pen. I mean, it's not an expensive pen. Let's say I bought it for $10, okay? Under normal GAAP, you would depreciate this, let's say, over 5 years. So after year one, theoretically, on our financial statement, it's worth $8. If I went to you and let's see, my dog chewed on the end, I dropped it a few times, this thing's a little wiggly on here. I mean, would you pay $8 for this? No. Well, see, so the fair market value is something less than $8. And so everything on any acquisition you do has to be fair market valued. So the loans obviously is the biggest piece of a bank. I mean, typically banks make their money through interest income, so the lending side. The securities portfolio. that has to be entirely fair market valued. And when you're talking about securities that don't have a lot of liquidity, I mean, that can be you can have some pretty big swings. Fixed assets, the pen, the desk, leases. Leases have to be fair market valued. Once again, if you're renting some space at $35 a foot and the market's $20 a foot, is that lease fair market value? No. And believe me, when the crash happened, all those leases were paying too much. I mean, they all had to be fair market valued. So all of this has to be done. And this is where it really gets to be tricky. Because, I mean, you know, when you're looking at acquisitions, if you don't do a good job with this, it could come back to haunt you. And it also is very difficult, whether you're doing a failed bank deal or whether you're acquiring another institution on an open market, for them to understand that this pen is not really, it doesn't matter what it says on your financial statement, it's not really worth $8, it's worth $3, and making people understand that. And I'll give you a really big example of it. There's a bank in Southeast Florida that's been around since the 1920s. It's the only bank, I think, in Florida that's really made it through really almost 2 depressions. And they have their corporate headquarters on their books for $1.5 million. They just got a contract on that property from what I heard, for north of $50 million. So you talk about a distortion of a balance sheet, because that balance sheet is not fair market valued. And that's the trick to really understanding that. We talked about the securities, we talked about the leases, equipment, intellectual assets, that's another thing. You know, I doubt in a failed bank you'd probably have an intellectual asset there because it failed and there's a taint with that. But if you were to buy another bank and it's got a great name, like Wachovia, which I never could quite figure out what that really ever meant. I don't think it really meant anything. I just think they made up that word. But there's a value. Your accountants will argue there's a value to that name, and that you've got to pay for that. There's a fair market value to that name. So these are things as you get into when you're working for these investment banking firms, and you know, you've got to be able to understand, you've got to be able to compartmentalize all these different items and be able to come up with a value on all this that you can defend going down the road. Any questions about fair market value? No? Okay. And there's a lot of companies that help you with that, but you can't just rely on those companies because sometimes they're just really off base. I mean, you know, at the end of the day, you got to really look and see what makes sense. And also, too, understanding your fair market values when you're buying another bank can come into play. That's where sometimes your gain or your better part of the deal can be. If you can convince the other side that the fair market value of this pen is really $1 when it's really $3. I mean, that's where the art of the deal comes in, so to speak. You got to look at risks in terms of any risks built into the customer base related to Bank Secrecy Act and Patriot Act. As you all are aware, that banks ever since 9/11 have been chartered with making sure that we're not helping money laundering or potential terrorists. And you take on that risk. Yes.
This is unrelated, but how much leverage was typical of banks in the 2000 period?
What do you mean in terms of leverage capital?
Yeah.
Well, that's a good point. A lot of good banks failed not because they were bad banks. They just ran their leverage too high. In American banks, the general ratio is an 8% capital. So, like for every dollar of capital, you can lend $12. So that's generally the ratio. Now that's going more to a 10% type capital ratio. The European banks their capital ratios were much, much higher. They got slightly different accounting rules. But a lot of times, a bank would fail simply because it was just bad timing. They were trying to be efficient. They were trying to get the highest ROE and ROA, which is what, as a CEO you want to do. The market crashed, and they didn't react and raise money fast enough, and they got caught. Does that answer your question?
So would you say that as a result of pursuing ROE that maybe the credit standards
No, not credit standards. I think it was just, the hardest thing right now, or the hardest thing, you want to get the highest return on equity, just like any investment, whether you're investing in Colgate or a pharmaceutical company or whatever. You want to get the highest return on equity. And the only way you can do that is by the easiest way to do it is to reduce your capital, get your leverage as high as possible. I mean, that's the name of the game in a bank. And so if a bank was moving around at 8% capital and the downturn happened, everybody had some problems. We had problems. We made some bad decisions. There's no question about it. There was no wiggle room there. And so they got pushed over the edge a little bit. And that's why you see, Basel III, where they're asking for, different risk weighting on the proposal for Basel III for different risk weighting on different assets depending upon, what they are. You'll see that the regulators have pushed up the capital requirements for a lot of banks. And now I think the market's looking a little bit more with banks that are running riskier type operations, requiring that maybe, okay, the rule is 8%, but you really need to have 10, and to try to avoid that going forward. But this is a real serious issue in terms of compliance. Something you got to look at, something very difficult to look at. But the minute you take over any bank, you acquire all the risk associated with that. If we were to buy a bank today that had been around for 15 years, anything that they had done 10 or 12 years ago, money laundering wise, that maybe they weren't even aware of, you pay the price for that. So it's a big risk factor that it's very hard to evaluate down the road. And let me put this, banks have spent millions of dollars trying to comply. Go back and look at every customer from 2002 to 2005. I mean, just the amount of money that they spend in terms of compliance is extreme on this. And that goes back to the different categories: money services businesses, international exposure. Other questionable business practices could also be in there. So these are all things that you got to be aware of. But the landscape has changed in terms of acquisitions. The fair market valuing has really taken the analytical side to a much more important level. You just can't take somebody's book value. You can't just take this pen and say it's worth $8 and make an acquisition. You've got to really understand what's behind those acquisitions. And that's where I think, you guys understanding how that works and being able to be creative in terms of but being able to utilize the fair market valuing to get a better valuation for whoever you're working for, whether it's the buyer or the seller, is going to be critical.
Going forward, do you feel there's still as much value out there as there was in part of the crisis to acquire different banks, especially
Well, I think a failed bank, the answer is no. I mean, there's too many bidders, and they've languished for so long. Those assets, whatever good clients they had are probably long gone. Good employees. It's just, it's been a long cycle. As far as other acquisitions, I think yes, there's a lot of opportunities. Compliance costs has gotten very high. I think a lot of smaller banks are going to have to do something. They're never going to be able to get the ROE and ROA they need. And so I think what's happened is, and they're tired. My hair was brown when the cycle started. It's not anymore. People, it's so funny, I'll see somebody I haven't seen in 5 years and they're like, they jump back, like, what happened to you? They're tired, and there's a lot of fatigue out there. Boards are fatigued, CEOs are fatigued. And so you're going to see, once you start seeing a little bit of a multiple, for an acquisition, then I think you're going to start seeing a lot more, just like the ABA said. I'm not so sure that's going to happen this year. The biggest thing that's hurting bank acquisitions is twofold. One is, Dodd-Frank is still being rolled out. There's only about 50% of that's been rolled out. And there's, we constantly are getting new directives like, okay, derivatives have got to go this way, and mortgage banking has got to go this way. So I think a lot of banks have are playing more defense in terms of just making sure they can comply with Dodd-Frank. The other thing is currency. Banks aren't trading at a big multiple. You've got to pay a big premium to somebody, you need to be trading at a high premium. Otherwise, your goodwill is just going to be crazy with the fair market valuing. So, when banks are trading at book value or less than book value, it's nearly impossible for them to really pay a premium. When you do the math, when you do the fair market valuing, as a general rule, I mean, from what we've seen is, you can probably pay about 0.15 to 0.25 above your valuation. So if I'm trading at 120 a book today, I can probably pay the max of about 145 a book of another company before you start getting into a situation where your goodwill or your dilution is too great. And so, you know, until currencies come back up, until bank stocks start coming back up, it's going to be hard. It's going to be real hard to pay those premiums.
And that extra multiple you pay is the built-in low-hanging employment cost, well, scale.
Yeah. Yeah. Typically, you want to repay whatever dilution you have in your stock. You want to have that repaid within 24 months from the combined entity. And that, you know, something we didn't talk about is analyzing cost cuts and things like that and being realistic. I think in the lunch we talked a little bit about how it amazes me how people fall in love with deals, and they'll sit there and say, okay, well, you know what, it's going to take 36 months. Okay, we'll just increase what amount of growth they're going to have. Go take it from 10% to 20%, meaning the acquired company, like you're going to make it grow that much faster. And I'll sit there and, you know, it'll amaze me because their own company hasn't even grown 20%. And they're making these wild assumptions to try to make that dilution go away. But the analysts really don't want to see much more than 24 months in a deal. So if your stock price isn't very high, you know, that dilution of your stock will get hit, will be bigger. And it just makes it that much harder to put a deal together. So. When you do an acquisition, that's very tough. And certainly with the FDIC deals, it's almost impossible to, we have what we call asset liability committee, basically, where quarterly we look and see from an interest rate perspective, interest rates go up, will we make more money, or they go down, will we make more money, and you got policy guidelines and whatnot. It's impossible in the time frame they give you to put that in. You don't even have the information, really, essentially, to be able to put it in properly until you actually have converted that bank into your system. There's no real way to know. Now, on a regular bank acquisition where maybe you have it over 4 months, you've got the time to kind of make some manual type adjustments and make that happen. But, you know, diversification is important. You know, we were looking at a bank just recently. You know, you cannot just, you know, lend on one particular asset class. And we have a lot of commercial real estate in our portfolio. This bank had almost all their portfolios commercial real estate. When you combined theirs into ours, I think it would have been a regulatory issue. So you have to be able to look at that and say, look, you know, this isn't going to make sense long term. I'm going to have to tell my lenders, look, you can't make another commercial real estate loan for 2 years until we get that diversification back. That just doesn't make sense. Very hard today with the computer systems and the interest rate models. Unless you're on the same system, it's very difficult. You got to make a lot of assumptions. The foreign interest would be via a bank like a Brazilian bank that has a bank as a subsidiary here. It wouldn't be a foreign bank. It'd be their subsidiary that would be bidding on it. The Bankia, for instance, I believe down in Fort Lauderdale or down in Miami, they bought. That's a big Brazilian bank, but a small subsidiary here. They recently did a failed bank deal. So it has to be through a U.S. subsidiary. It has to be through a U.S. subsidiary. Where? I think, you know, it used to be 3 years ago, the investment bankers would come by and they'd say, look, you have to be $1 billion to survive. I mean, really, to get that ROE and ROA. My sense is more you've got to be $2 billion. Now, that doesn't mean that a bank that's $150 million that's in some rural community where they have a, you know, 80% market share and they can charge 8% interest, you know, and they fill a very important role because Wells Fargo isn't going there. I mean, can't survive. I mean, they will survive. But I think in metropolitan areas, I think you're going to see that consolidation of those smaller banks is going to really pick up pace once the regulatory side kind of smooths out a little bit, as well as the stock prices go up. Because you just can't, the compliance side of it, you got to have, not only is it money, it's sophistication. You know, you got to be able to hire the right people. And a bank that's $150 million can't hire a compliance person that makes more than the president. I mean, I guess they can, but you're not going to see that happen. And so you're going to see a lot of consolidation in that. It's going to pick up pace. Well, that's like the best kept secret of banks. Margin compression is going to be extreme. I mean, it's going to be a lot worse than people. I think there's some analysts that said Wells Fargo last quarter, they were anticipating 10 basis points of net interest margin compression. And you think, well, one big deal, 10 basis points. Well, think how big Wells Fargo is. I mean, think about how many billions of dollars of assets that is to have to reprice. You're going to see that's also pushing down earnings, and that's going to be a big issue. It's also creating some risk, I think, in the banking industry because banks are chasing higher yields, or chasing any yield, and taking more interest rate risk in terms of duration. We're seeing that both in the securities portfolios as well as the loan portfolios. But you're right. I mean, a smaller bank, I mean, you got the increased compliance risks, or you got the increased compliance you got to do, as well as shrinking margins. I mean, it's hard to win. It's really hard to make any sense of it. Questions?
How often would you say with such a quick turnaround of 2.5 days in the whole process?
Yeah.
Being so short, how often would you say the acquisition of a failed bank doesn't work out? When maybe like a bank acquires a failed bank and realize a month later, oh wow, we really don't want to deal with this. They try to sell it on their own.
Well, you can't sell it at that point. I mean, you know, you remember a lot of the banks did loss shares. In the loss shares, you're not allowed to sell. At least the government has allowed. I'm not sure you're not allowed, but they have not allowed you to sell those loans. I mean, you can liquidate them, but you can't sell them. I mean, the idea was, I think the idea that the government, and I'm speaking for them, I shouldn't be doing that, but I think the idea was they wanted stabilization. They wanted banks to go in there and actually stabilize those banks and serve the communities, and I think for the most part they did that. Did some banks do some bad failed bank deals? Certainly. You know, in the 4 we did, I mean, I've got one that's just, you know, it was the best thing since sliced bread. I've got another one out here. I'm like, well, you know, if I'd do it again, I probably wouldn't die and lose money, but it probably wasn't worth the headache. So. Any other questions about banking in general outside of acquisitions and that sort of thing?
We'll say my friend Richard and I wanted to start a bank.
Yep.
What would we go about?
Well, they haven't been granting many charters lately. Don't do it. They haven't been granting many charters. It really, to be honest with you, and I don't know what the new system's going to be. If there is going to be a new system, you know, eventually I would assume the government's going to allow new charters. The process was about an 11-month process. You know, you hire a consultant. You know, you have a copier box full of documents, basically. You got to be able to raise the money, and you know, typically the minimum is probably somewhere between 12 to 15 million. My guess is where the new minimum will be, where you've got to be able to raise that money. So you have to be able to demonstrate that. You got to have a board that has a certain level of banking experience. You got to have a management team that has a certain amount of banking experience, and they all have to be approved. The background checks and all that sort of thing. And then you got to have a business plan, and the business plan has to make sense, and the projections have to make sense. And now, one of the things that we saw, a lot of banks failed because they really didn't follow their business plan. You know, they had a good business plan. You know, the boards would get impatient with the management team and say, you know what, we want, you know, my friend at the country club's doing this, so, and his bank sold for this, so we think we need to be doing this, and the next thing you know, they change the business plan, fire the management team, bring in a new one. So I think, from my perspective, I think the government's holding people to their feet to the fire, and you're a de novo bank for 7 years. So you have to refile that business plan every year. You're also, when they come in and examine you, they make sure you're following your business plan. So it's not as easy as it used to be. You know, the question is you know, what's the future for the smaller banks? You know, would you really want to do that at this point? You know, I mean, it's, you know, having been there and done that, I'd say I'd sleep long and hard before I consider doing that. But you know, at some point, I would think the government will open up those opportunities again. You know.
But do you think picture or a difficult uphill battle for small banks for certain points? You did say a while ago, and I've heard this before, that there are significant amount of credit to be lending customers for which large banks will never top.
Right.
So there is that. There's the customer base. So who's going to serve it? Consolidating small banks or big banks?
Well, that's my concern about the economy in general, you know, and I'm going to get into politics a little bit here. It's not the regulators that are the problem, it's the politicians in Washington. and it's a political issue, you know, and you know, bankers are not the most popular people, you know, but you don't, in this class, if 2 of you are misbehaving, you wouldn't punish the whole class. And that's really what's happened in the banking industry, in my opinion. The regulators are just doing what Washington tells them to do. And it's really coming out of Washington. And in my personal opinion, it's a political agenda. No one likes bankers. I mean, so let's pound on them a little bit and get some more votes and get reelected or be elected. And I'm not Republican or Democrat. I mean, both parties are no better than each other. But you know, that is the problem with the economy, is what happens when these smaller banks go away. How does that small to medium-sized businesses, where do they get credit? I mean, it's going to be, and that's where I think this economy would be if in my opinion, if the pedal was lifted a little bit off the banks, I think this economy would rebound quicker. You know, big companies, big corporations are not opening new plants in the United States. I mean, let's face it. When you can go to China or someplace like that and your employment costs are a lot less, why would you open up in Gainesville and have to pay 5 times for an employee here? I mean, it's all being outsourced. So where is the employment going to come from? Where are people going to be hired? I mean, it's going to come from a small business that starts out with 10 people. The next thing you know, it has 20 people. The next thing you know, it has 50 people, and it has 100. And it gets so big that it outsources, but that's a whole other issue. But you know, you got to have somebody who's funding that. We call the big banks, about 95% of our business comes from the big banks, and we call it the gift that keeps giving. I mean, they just you know, they're so big, so impersonal, it's very difficult for them to give the quality service. And our philosophy is more old-fashioned, too. I mean, our account officers actually do the analytical work. They actually understand their customers. We consider ourselves more of a consultant than a banker, kind of like, you know, you saw a movie from the 1940s or something like that. And we'd like to think, like, before a company, one of our middle market companies makes a decision, they call their lawyer, their banker, and their accountant. You know, and the differences between us and them calling one of the big money centers bank is they've had 5 different account reps in the last 3 years, and they've had the same one for the last 5 years with us, and they understand their business. But that model is very much of a dinosaur, you know, as time goes forward.
I think I'm just picking this up, but it's critical. So I'll do this in 2 parts. So that had to do with regulation. So I was at a cost share every year. I was with the former chairman of DILIGENCE, and he quoted a number of what they spent on regulatory compliance. That was astronomical. I mean, I couldn't even, if he had shaved the number by 1,000, I wouldn't be shocked.
Right.
And the number of headcount that they had on the board, the nutrition board had employees that they had actually. So that just dragged, right?
Right.
Part B is, if I have it right, is that that's disproportionately expensive for you as opposed to more small banks.
Yes. Yes. I mean, you know, the bigger the bank you are, the more money you can make, the more efficiencies you get. It's just economies of scale.
There are some economies of scale.
Huge in banking, huge in banking. I mean, the beautiful thing about banking is, you know, I don't even have to show up to work tomorrow and I make money. You know, I mean, when you think about it, and when you're a big bank, you make a lot of money just by not, you know, just by the, you know, it's a spread business. I mean, and then most of the non-interest income that banks make is recurring, you know, other than the investment banking side and stuff like that and derivatives, but most of it's recurring. So, yeah, the bigger the bank are, you can afford that. I think we probably hired, we hired a lot of people last year. We were very bullish on the economy. I think we hired about 20 people. Probably realistically 7 of those 20 were somewhat related or related directly to compliance, regulatory side. You know, their full-time job may not have been for all 7, but a lot. I mean, so that's really pretty disproportionate. You know, but take that down to a $200 million bank. You know, for them to hire 3 people or 2 people would be, you know, it's the difference between being profitable and not being profitable. Chances are, you know. So it is a scalable business. It is a scalable business. That's where it gets back to, you know, getting back to what somebody asked about the M&A activity is going to pick up. We feel like, I feel personally, you really got to be about $2 billion to really be able to get that return for your investors. That's going to really make some sense.
This is fascinating. So that number, you wouldn't think that was the number back 15 years ago on a different regulatory, obviously, millions of banks that survived.
They were saying 500 million back then. It went from 500 to about probably the investment bankers $1 billion about 3 or 4 years ago, and now it's Most of them are hovering around that $2 billion mark. And if you look at the efficiencies of the banks out there, the banks that are somewhere between 5 and 10 billion, they're the ones that seem to be doing the best right now in terms of return on equity and just in general growth and everything. It seems like that's small enough to kind of dodge some of the compliance issues, but big enough yet to have scale and be able to get out there and really grow and make things happen. So. No, we don't actually, because we sent out 2,300 proxies last year. We're over the counter. There's an interesting rule for banks. If you've got less than 2,500 investors, you don't have to do SEC filings. Now, you could have 400 people, 400 investors that are all in Merrill Lynch, and they keep that stock in the street name, in Merrill Lynch's name. That counts as one. So it's a kind of a loophole, so to speak. I'm not sure that's the right word, but we've been able to stay on the bulletin board and still have a liquid stock, even though we do plan on gravitating to NASDAQ at some point in terms of that. But the compliant, once again, that's another cost. It's probably about $300,000 to $400,000 a year in terms of cost to go fully public. Well, wealthy. We have a lot of private banking. Wealthy people. We've got a lot of very large depositors. In banking, those companies, we do all their treasury management, so we got all the corporate deposits as well. Probably about half of our liquidity is corporate deposits. So, and we know law firms and doctors' offices and that sort of thing, medical, professional, and so on. Yes. Yes, I think so. Once again, it goes back to service. Retail, it comes down to convenience and fees. But private banking is a relationship. I know the CEO of the bank, or I know, this person or that person and that sort of thing. And that's critical to the whole thing. And that's where, when you get to a certain size, you lose that touch. And that's when things change. We're higher, but we have less in non-interest expense because we have less branches. We think we've never really done a study to see, it's a very good question, by the way. We've never really done a study to see if we had 5 more branches, what would be and our costs were 20 basis points less, but yet we had all this non-interest expense. What would it be? That would be an interesting thing. Maybe I'll give that as a project. No, I mean, so that's the model. The model was very much driven towards, look, we're going to pay a higher amount for the deposits, but we're going to have a lot less employees. We're I think 12th in the state in terms of assets per employee. And that's really, we try to be in the top 10. So, good question, though. Anything else? Well, beautiful. I really enjoyed it. Let me share one story with you. It was interesting. I was meeting with not a low-level person. Actually, this person runs a whole division for the country of one of the large accounting firms. And I talked about, I was coming up here and doing the speech and how excited I was. And I said, do you do a lot of recruiting at UF? And he goes, yeah, we do a lot of recruiting at UF. I go, well, how many, well, we hire as many UF grads as we can. I go, what do you mean by that? He goes, look, we will go 50 deep in the accounting area at UF. The other state schools will go 3 deep. Give you an idea of how lucky you are to be here and what a great job you guys have done, the facility, the staff and everything. I mean, coming, you don't see it, you're here, you don't see it 15, 20 years from now, you will, but when I graduated from now, what this school has done and what this university and how it's grown in terms of how it's felt throughout the state and throughout the country, it's just amazing. And where you're placing students, that didn't happen when I was graduating here. That didn't happen here. So, it's a real credit to you guys and the hard work you guys do. And I'm extremely impressed. And I'm going to spread the word when I go down south. And hopefully maybe some of those middle market companies will be looking for some analysts and so on. But it's truly an honor to have done this. And I wish you all well. And if you ever want to contact me, just pull up our website. Please feel free to give me an email or give me a shout. Thanks. Appreciate it.